Hello and welcome to the Macro Robert for the end of the week, for the week that began the 14th of August 2017. Quickly look at the geopolitical tensions. As I said at the start of the week, it was going to be there. So we got the tail end of the North Korean issue and the start of what I think will be probably a theme over the 4 years of Donald Trump's presidency, which is friction inside big business, small business, also around the horrendous issues that happened over in Charlottesville. Again, the way I look at it is that it is and needs to be part of your risk tolerance. It is going to be an intraday or an intra-week issue and something that you are always going to have to sort of deal with the current markets and the current setup that's going on over in the US. So despite the volatility, despite the downward trend, you need to look through it. So what I mean by understanding risk tolerance is that this is just unfortunately part of what is now making up markets is geopolitical tensions. And that's probably where I'll leave it at that. And just therefore, keep it in mind. It will probably happen several times again over the next couple of years. And that is basically going to be a dead fact. What I do want to look at this week is the two major pieces of Australian data that came out and what is probably now becoming quite an interesting scenario for portfolios as well. Wednesday's wage numbers were, as forecasted, weak. There is no other word to use for them. They were very, very soft quarter on quarter, only growing by 0.5 of 1%. Year on year at 1.9%. That is, again, welded at record lows. Now, the whole sort of reporting of this has only been going on for about 25 years. So again, you can point to that as being, part of the data. But in saying that, it means therefore that overall wages, excluding bonuses, is only just growing above inflation. So inflation on a trim mean basis is 1.8%. That is not brilliant in terms of what you look at it. If you look inside the private numbers, it's even worse at 1.4% year on year. It basically means that the private sector is losing money year on year with regards to how they're seeing growth in their wages at this point. And that gets back to what you're now seeing from the minutes this week and also what you saw from the employment numbers is that everybody's aware that wages aren't growing, but everything else is actually moving in the right direction. The employment numbers were really quite rosy and quite strong, and leading indicators suggest that employment will continue to move in the right direction. There's a few charts that I will point as well. If you have a look at the weekly hours earnings, they actually back up the wages. And if you have a look, they're moving towards 6 or 7 year lows. And you can see at the moment that they're actually below what you would expect in this current environment, considering how strong business is, considering how strong employment is, that those weekly hour numbers are really quite soft. So there is that sign there as well. So the minutes told you that until wages move, they're not going to move. But if they are going to move, it's to the upside. So this is the real dilemma at the moment around what's going on in Martin Place is that they're out. They're not going to change rates in either direction for at least 12 months. I actually think at best next December is if they're going to move rates in either direction because inflation, A, isn't coming, and the inflation in wages, with it being that low, is going to put pressure on housing. It's going to put pressure on that debt to income ratio that everybody points to as well. So all that filters into what does it mean for your portfolio? Look at the banks. They are clearly trying to start moving away from being exposed to holding the risk on the principal side and forcing you into principal and interest only loans rather than moving into interest only loans. I think you're also going to see the banks start asking the question about whether or not they need to start increasing rates independently like they have, particularly around those that are paying interest-only loans to try and force them across even further and reduce the risk in their portfolio because they're the ones that are actually currently holding a huge amount of asset risk that if you did see all of that wage issue filter into a slowdown in the housing market, then that is also something that they're going to be holding. So it's a real interesting sort of dilemma over the next 18 months about how the RBA, the banks, and just the general economy sort of weathers that. So that's what came out of this week. Real interesting from the economic side, but as I said, that geopolitics is going to play out for a little while longer, and for that reason, just know your risk tolerance.
The essence of robo-advice is using technology and digital services to help members or clients reach their financial goals and helping you improve your portfolio through diversification. That's investment advice. That's automated investment advice. By using technology and automated services is being able to deliver those services cheaply and affordably. Robo-advice or automated investment services are just the start.